In September of 2019, something broke in the plumbing of the financial system and almost nobody noticed. There was no crash. There were no headlines about markets in freefall. Stocks were fine that week. The news cycle barely blinked. But behind the scenes, in a market most people have never heard of, interest rates briefly spiked so violently that the Federal Reserve had to step in with emergency intervention for the first time since the 2008 financial crisis. And the scary part isn't that it happened once, it's that the exact same conditions that caused it are quietly building again right now. So let's rewind, because to understand why an obscure corner of Wall Street almost broke the entire system, you first have to understand what the repo market actually is. Every single day, banks, hedge funds, and other financial institutions need short-term cash, not for years, not even for months, sometimes just for one night. And rather than sitting on idle cash reserves, these institutions borrow and lend to each other constantly, using something called the repurchase agreement market, or repo for short. Here's how it works. Meet Dave. Dave runs a hedge fund and needs $100 million in cash overnight to settle a trade. Instead of selling assets outright, Dave takes some of his Treasury bonds and temporarily sells them to another firm with a promise to buy them back the next day at a slightly higher price. That tiny price difference is effectively the interest rate on an overnight loan. And that's a repo transaction. Multiply that by thousands of institutions doing this every single night, and you get the repo market, which quietly moves over $1 trillion a day. It is, without exaggeration, the plumbing that keeps the entire financial system's short-term cash flowing. And normally this market is boring in the best possible way. Rates stay low, stable, and predictable, hovering close to whatever the Federal Reserve's target rate is. Nobody thinks about it the same way nobody thinks about the pipes behind their bathroom wall until the day the pipes burst. And in September of 2019, they burst. Overnight repo rates, which usually sit around 2%, suddenly spiked to nearly 10% in a matter of hours. Institutions that needed overnight cash were suddenly being charged 5 times the normal rate, seemingly out of nowhere. And when short-term borrowing costs spike that violently, it's not a minor technical glitch. It's a signal that the market ran out of cash to lend, even though the financial system as a whole was on paper doing just fine. So what actually caused it? Well, it turned out to be a perfect storm of boring technical coincidences stacking on top of each other. First, corporate tax deadlines hit that same week, which meant companies were pulling large sums of cash out of the financial system to pay the government. Second, a large Treasury bond settlement was also due around the same time, which meant even more cash was being absorbed to pay for newly issued government debt. And third, and this is the part that mattered most, banks were sitting on far less spare cash than regulators assumed, because post-2008 regulations required banks to hold larger reserves for safety, which meant less of that cash was actually available to lend out in the repo market on any given day. So when multiple demands for cash hit at the same time, there simply wasn't enough supply sitting around to meet it, and when demand for a very short-term product suddenly overwhelms supply, prices don't rise gently. They spike violently, almost instantly, because nobody was set up to absorb the shock. And here's why this actually terrified people who understood what it meant. Because the repo market isn't some side alley of finance. It is the foundation that keeps short-term borrowing costs stable for the entire system. When repo rates spike, it doesn't stay contained to repo. It ripples outward, because banks use the repo market to manage their own balance sheets efficiently. Hedge funds use it to finance leverage trades, and money market funds use it as a core place to park cash safely overnight. So when that market seizes up, even briefly, it threatens to freeze funding for parts of the financial system that have nothing to do with the original cause. The Federal Reserve had to respond immediately, injecting tens of billions of dollars into the repo market within days, and eventually hundreds of billions over the following months, just to bring rates back down to normal. It became one of the largest emergency liquidity interventions since 2008, and most people never even heard about it because it wasn't a stock market crash. It was a plumbing failure fixed quietly behind the scenes before regular people could feel the consequences. But here's the part that should actually worry you. The Fed's emergency fix in 2019 didn't solve the underlying problem, and it just papered over it with liquidity. And the exact same structural conditions that caused the 2019 repo spike are quietly rebuilding themselves right now for a very specific reason. The U.S. government is running trillion-dollar annual deficits, which means the Treasury has to issue an enormous and growing supply of new government debt every single year just to fund existing spending. And all of that new debt has to be absorbed by someone using cash that would otherwise be sitting in the banking system ready to support the repo market. At the same time, bank reserves, the exact cash cushion that ran short in 2019, have been steadily declining as the Federal Reserve continues shrinking its balance sheet through a process called quantitative tightening. So you've got rapidly growing Treasury issuance pulling cash out of the system on one side, and a shrinking cushion of bank reserves available to absorb short-term funding shocks on the other. That's not a hypothetical. That's the same combination of pressures that caused the spike in 2019, just larger in scale, because the debt being issued today dwarfs what existed back then. And there have already been smaller warning signs. Repo rates have spiked briefly multiple times over the past 2 years, nowhere near as dramatically as 2019, but enough that the Fed has had to quietly step in with short-term liquidity operations more frequently than they'd like to admit publicly. Each time it gets fixed quietly, and each time almost nobody outside of financial trading desks notices. But every one of these smaller tremors is a signal that the underlying cushion of available cash in the system keeps getting thinner, even as the amount of debt that needs to be financed every single day keeps getting larger. So why doesn't this get covered the way a stock market crash does? Because it's not visual. There's no dramatic red arrow to show on a chart, because most people don't watch overnight lending rates the way they watch the S&P 500. It's not a headline you can doom scroll, because it requires explaining what a repurchase agreement is before you can even explain why it matters. So instead, financial media stays fixated on whatever the Fed says about interest rate cuts, while the actual plumbing underneath the system and the mechanism that determines whether short-term borrowing works at all keeps getting less resilient with every passing year of trillion-dollar deficits and shrinking reserves. And here's the uncomfortable truth nobody wants to say directly. The 2019 repo spike wasn't a crisis caused by reckless trading or a bad bet gone wrong. It was caused by simple math: too much demand for cash, not enough supply sitting around to meet it at exactly the wrong moment. And that math hasn't gotten better since 2019. It's gotten worse because the debt keeps growing, the reserves keep shrinking, and the buffer that's supposed to absorb these shocks keeps getting thinner every single year, which means the next repo spike isn't a matter of if, it's a matter of when the next set of coincidences lines up at the wrong moment, the same way tax deadlines and bond settlements lined up in September of 2019. And that's why I made this channel, because the real risks in markets are never the ones making headlines. Those get priced in, discussed, and eventually absorbed. The real risks are sitting quietly in the plumbing, in the parts of the financial system too technical and too boring for anyone to explain on the evening news. So if you want to actually understand what's happening beneath the surface, hit subscribe, because I'll keep covering this stuff. Traditional financial media won't.